Hi, everyone. I'm Helen Lin, CEO, founder of Discern. I've been analyzing data my entire career, starting at the Boston Consulting Group. Throughout my career as a consultant, then chief of staff at IHS Markit, Goldman Sachs, and working at a PE-owned portfolio company, I've analyzed data from all sorts of systems, of which the most important is the CRM, which led me to start Discern. So I look forward to sharing some of my learnings with you today and have a fun and productive conversation. Over to you, Dawn.
Thanks, Helen. Hi, everyone. I am Dawn Poulos. I am one of the co-founders of Covizio, and I have spent over 20 years as an operator, starting out in enterprise sales, selling non-SQL databases. What fun. Moving on to an XDR leader, and then moved into marketing, where for the past decade plus, I have held CMO roles at various high growth companies. I've actually spent the last 5 years in consulting, something I never thought I would do. But it turned out to be an amazing experience working with companies just like yours. And I look really forward to sharing a lot of the pattern recognition that I've collected over that time. So like Helen, looking forward to a fun event.
Okay, well, thank you for joining us. Dawn and I actually went to the same business school and were in the same business school class, but we didn't meet until recently at an industry event. So we realized that we have been solving the same go-to-market problems from different angles. So we decided to combine our knowledge base and share with this audience. So we will kick off today's agenda by sharing the latest sales performance benchmarks, followed by reasons for inaccurate sales forecasts, and then share a proven sales forecasting framework, which we call the 4Ds. So on sales benchmarks, since Q1 just ended, I wanted to share some data with you. When we look at benchmarks, these benchmarks are based on 30 or so B2B tech companies with whom Discern system is connected. Therefore, this is data directly from the CRM, not self-reported, so you can rely on this data. We did not include companies whose fiscal Q1 have not completed, and all data presented here are median numbers for each metric, but there is a distribution, obviously, for each metric. So let's take a look at closed deal metrics. Win rates increased in Q4, but declined in Q1, which is probably reflective of seasonality. But that said, Q1 win rate was not as high as last year's Q1 and actually declined quite a bit. Sales cycles started to increase in Q3 of 2022, which is not surprising given the economic environment, but have since stabilized, which is great. The ASP change quarter over quarter is always pretty dramatic, and we are seeing that pattern in Q1 again. So nothing surprising there. Now, let's take a look at open deals. When we look at open pipeline performance, we look at conversion rates. Conversion rate is defined as of total open pipeline to close within a quarter, the amount that was won within that quarter. Conversion rate started to decline since Q2 of last year, driven both by early stage to late stage conversion, but mostly by late stage conversion. What this is telling us is that these days, deals are not as easily won as they have been in the past. As a result, the largest decline in quarter over quarter ARR bookings, if we can go to the next slide, is in Q1. And though from an efficiency perspective, ARR bookings per ramped rep has stabilized from Q3 of last year, which was the lowest point for sales efficiency. So just like the current economic environment, sales metrics are in flux. With this challenging backdrop, I'm turning it over to Dawn to talk about forecasting.
Excellent. And Helen, you forgot to mention that we had been collaborating for a good 2 or 3 months before we actually discovered that we were classmates. So just wanted to add that on. So
Awesome.
One of the things, so I just want to repeat something important, something that I keep telling myself, that, some of the most successful companies have been born during a recession. So all the way from Microsoft in the 70s to Electric Arts in the 80s and Airbnb and Square during our latest, the Great Recession. So forecasting is really all about managing spend for efficient growth. And so it's really important given what we've heard, but we've been really bad at it for a really long time. So I really want to try to dig in and figure out why 80% of companies are missing their forecast. So we're going to go through these. So you talk about the number one, culture and adherence. And what I mean by that is there's this overlooked reason that forecasting is a problem, and that's because it's not a team sport. And I'm going to and because it's not, it drives a certain set of behaviors. These behaviors that are not really, they're bad for your internal culture and they're bad for your customers. And what I mean by that is forecasting really right now, it is disproportionately focused on and driven by leaders, okay, with little ongoing input from individual contributors. And so when that happens, we create this very kind of me-centered, cutthroat sales culture that prioritizes customer signature at all costs. And so I'd like to argue that if reps really understood that an accurate forecast has a direct input on their own and their support team's current quarter earnings potential, and that it could tee up future quarters for a pipeline that's ripe for expansion and upsell, we wouldn't see things like, this animosity between sales and other functions like marketing and the XDR team. We wouldn't see this sandbagging to give the impression that you're exceeding expectations. And what most important is we have customers who are really starting to see value what was sold to them. That's not happening today due to this rush to signature. So we're going to get into that into the hows to fix that. But I'm going to hand things over to Helen to talk about another potentially bad behavior, which is the weighted forecast.
Okay, so the second problem here is weighted pipeline. While bookings is a leading indicator of revenues, pipeline is a leading indicator of bookings, which is why it is super important. Now, companies often look at weighted pipeline to get a sense whether bookings target can be achieved. However, the weighted pipeline as a metric can be quite deceiving. Depending on how a company calculates the weighted pipeline throughout the quarter, it can often overstate the health of the pipeline and lead the management to think they're in good shape, only to miss the target toward the end of the quarter. The reason is that many companies assign an arbitrary percentage to the weighted pipeline, like 90% to contract stage, 70% to negotiation stage, or 50% to the proposal stage. The actual weighting can actually be quite different and should really be based on historical conversion rate by stage. The actual weighting is calculated. A lot of companies don't really calculate it. So weighted pipeline as a concept is great, and it really can be utilized for forecasting, but the weighting is oftentimes wrongly assigned. All right, so back to process, Dawn.
Yeah. So let's talk about bad process and too much data. So it's not that people are ignoring the forecast. That's not it at all. It's just that there's really not a clear understanding of how to manage the process and to apply the proper discipline to it. So we can group these into three buckets. The first is definitions. I want to make really clear, even if you don't have a clearly defined sales process, definitions are going to get you a long way towards accurate forecasting. Create definitions that are hard and create definitions, and then create the hard and fast rules for moving them into a forecast category. And I want to use a real life example here. So, I had a client who we're working on 2 enterprise deals, right? Very large, multi-million-dollar deals. And we were working on the forecast. And she was like, I know these are going to close. In my heart of hearts, these are going to close. We all have these happy years, right? And so, but we created these very hard and fast rules. We said, if you know they have to have a mutual action plan, a close plan, right? And that close plan has to be created and it has to be agreed upon. So we had one that was closed and agreed upon and was moving along. The second one, the deal was moving along, but the closed plan wasn't quite finished or quite signed off by the customer. And so there was this argument, should we keep it? But the hard and fast rules was get it out of commit, move it to upside. And and because of that, as it turned out, that second deal because it wasn't agreed upon, it did get pushed out to the next quarter. So these hard and fast rules are really, really important. The second thing I want to talk about is cadence. Okay, so I want everyone here to think about all of the people involved in a forecast and what their individual objectives are. Okay, you have frontline managers and CROs who are trying to manage up. You have reps who are looking for guidance and help with progressing their deals. And then you have all of these other people involved in the deal desk that hold key information for making sure a deal crosses the line. So I'm just going to say it takes more than just weekly check-ins to cover all of that. It takes thought out coordination and orchestration. The third thing I want to quickly talk about is too much data. Okay, no, almost every company I have consulted with will tell me the same thing. We have tons of data. In fact, I have 92 dashboards at my disposal. I can tell you anything you want to know. And that really is the problem. Okay, because everyone has a dashboard to tell their individual story. But what I found is no one can connect the dots to tell the company's full story. Okay, so as a result, what happens are most organizations are trying to boil the ocean when it comes to solving the forecast issues instead of identifying the 2 or 3 things to prioritize that have an outsized impact on that forecast. So in a little bit, I'm going to show you. I'm going to teach you a little bit about running a forecasting cadence. But first, let's go to Helen to talk about all of those manual spreadsheets.
Right. Okay. So that's the fourth problem, manual spreadsheets, right? The lack of automation and the utilization of these spreadsheets to tell a story. Now, spreadsheets are highly time consuming to put together and may not have the latest data, especially when they're utilized for a weekly forecasting exercise. We all know that as soon as a spreadsheet is completed, it's outdated. So let's say an AE or manager forecasts 200,000 to win this quarter. If someone wants to drill down to see the opportunity details, they might not be able to. Even if they are able to, then the opportunity information is not the latest. It's not updated. And also, if you want to pinpoint performance for a specific segment, perhaps certain region is outperforming or certain customer segment or product line is underperforming, it's very difficult to look at a spreadsheet and see every dimension of the data. The worst part of using spreadsheets is that everyone has their own, right? So like Dawn mentioned, so no one is really working off of the same data and everyone is telling kind of their own story. So much for manual spreadsheets. Let's talk, on the flip side, let's talk a little bit about AI forecast. Now, given Discern produces AI forecast, you might wonder why I'm down on it. The fact is I'm not. It's just that sometimes there is inappropriate usage of AI forecast. What I'm trying to say is that relying 100% on AI forecast can be dangerous because the AI forecast doesn't include qualitative data or the human touch that only really an AE can sense. For very large enterprise deals, relying on AI forecast is particularly dangerous as they can swing your overall forecast by a huge margin. And AE's view is definitely needed in that case. Now, AI forecast can be good at the overall company level, and then it can also help you flag at-risk opportunities. But do not rely 100% on it to forecast your quarter. What we suggest is that you want to utilize a combination of AI and human forecast to forecast your quarter.
Okay, so let's talk about the 4 Ds now. Let's dig into how we're going to solve all of this. Okay, so 4 Ds: discipline, diagnose, dynamic, all powered by Discern. So the first thing that you want to do is you want to take a structured, simple, and systemic approach to forecasting, and that all starts with discipline. So I want you to think about your forecasting meeting if you're a rep. Reps get confused when they go into meetings with their frontline managers looking for guidance, and instead they get browbeaten about the forecast. Why does this happen over and over again? Well, it happens because companies typically combine forecast reviews and pipeline reviews into the same meeting. Liz, can we move to the next slide? Because they're typically combining these forecast and pipeline reviews into the same meeting. Both of these meetings are equally important, but they need to happen separately. I want you to remember, go back to something I said earlier. The frontline manager's objective is to get information so that they can effectively manage up. The rep's objective is to get help and guidance progressing their deals. Those are 2 separate objectives. They need to happen in 2 separate meetings. So let's talk about the forecast meetings. So these meetings are for managing up. Again, expectation setting, and taking the opportunity to leverage the senior management team to help with specific opportunities. So when you're in these forecast meetings with the C-level, you can get those board connection. You can have them make product roadmap discussions with the customer. They can help you with unique deal structures. Prep for this meeting requires extreme prioritization. using the information that you gain from your frontline managers and reps, making sure that you have measured asks, and making sure, most importantly, that you're following up from previous forecast meetings. This happens all the time. People have forecast meetings, they forget about it. You need to have your action items, you need to follow up. Then there's what we call the pipeline meetings. Again, this goes back to what I said earlier about reps being confident of maximizing their commission. Pipeline meetings are where we make sure that the support teams are on track, okay? That they're meeting their goals, they're setting up enough leads. It's where reps can get individual coaching from their frontline managers, and where frontline managers can step in, look at the pipeline as a whole, and help prioritize support from other functions. The key of these pipeline meetings is that you are trying to make the rep more productive. And prep for this meeting requires deal diagnosis, call reviews, or sitting in on some meetings so that you can do skills coaching. Now, the next set of meetings are these leadership meetings. And the reason that these are important is because you need to recognize that there are different roles, bring different fidelity to a deal, and you do not want to overlook these. I will tell you situations that I run into over and over again. An SE identifies an integration risk. Legal identifies a non-negotiable indemnity or IP clause. If you overlook these things, you risk bringing the deal out of the commit stage, which is something that you almost never want to do. So this is something that needs to be taken care of. And housekeeping. And housekeeping, I want you to think about this differently. Housekeeping, the objective should be where we start thinking about the experience, making the experience of the rep more meaningful. Okay, so I want you to think about it. Typically, CRM fields are defined by RevOps and finance, right? Again, reps aren't involved. And we typically see anywhere from 25 to 50 required fields. Okay, what you need to understand with the reps, you may have 25 to 50 required fields, but your rep needs to minimize their time away from customer-facing activities, and they need to ensure accurate data. So what you want to do is you want to automate the vast majority of fields that you can. And provide props on the next best action. And then even more important, those manual fields that are left, you need to make sure that those are input at the right time and aligned with the buyer's process. So I'll give you two examples. Close date and ACV. In almost every single Salesforce instance or wherever, you are asked to provide the close date and the ACV right when you do the opportunity, when you create that opportunity. You're never going to have that information at that point. You're never going to know what the close date is until you get the customer commit. And you're never going to know what your ACV really is until proposal. So what you want to do is make sure that you're not only having the right fields, but they are put in at the right time. So I think that's enough for discipline right now. I'm going to let Helen move on to the next D.
Okay, so the next D is diagnose. So for diagnose, we recommend 3 approaches. The first approach is to diagnose by funnel. The top of the funnel, middle of the funnel, bottom of the funnel. For top of the funnel is all about pipeline creation, as pipeline is the leading indicator of bookings. So you want to ensure that there is enough pipeline to feed the sales team. To figure out how much pipeline needs to be created, you need to know your target and your company's historical conversion rate. When you have calculated your conversion rate, then the inverse of that is your pipeline coverage goals. So if you're able to convert 33% of your pipeline that you create, then you need 3x pipeline coverage. Now, do not use the industry rule of 3x or 4x. Use what's needed for your company, as every company is different. Conversion rates we have seen for companies ranging from like 2.5x, right, to all the way to 10x. So that's top of the funnel. Figuring out what your coverage is, figure out what your conversion rate is. Middle of the funnel is about converting early stage opportunities to late stage opportunities. Here, we want to ensure opportunities do not stay in one stage for too long. So if you know in general how long a deal should stay in a stage for your team, then highlight the opportunities that have remained in the stage for too long. We also want to ensure that there is enough engagement or activities for opportunities and flag those opportunities that do not have enough activities. So in short, for middle of the funnel, measure early stage to late stage conversion rate, sales cycle by stage, and activity level by stage. Bottom of the funnel is all about closing. Again, measure sales cycle and activity level to ensure opportunities close on time. The result of bottom of the funnel performance will ultimately impact overall win rates and conversion rates. So for bottom of the funnel, measure late stage conversion rate, and then again, sales cycle by stage and activity level by stage. Our second approach with diagnose is segment analytics. Now that we've seen or we've studied the full funnel analytics and understand where things are going well and where things might have issues, you might want to break things down, break down the data by segment. So segments can be region, could be industry that you're selling into, it could be size of the deal, such as enterprise or commercial or SMB. Look at the data by segment. That will help us pinpoint issues and allow us to focus our problem-solving energy on specific areas so that we're not working on everything all at once, but are much more targeted and effective. Our third approach is opportunity inspection. The objective of opportunity inspection is to get an accurate view of the opportunity and its potential for this quarter. Are the opportunities in the right forecast category or stage? Are the expected close dates updated? How much of the forecast is coming from existing open opportunities, of which how much is in commit forecast category? How much of the forecast is coming from create and close opportunities? Therefore, do we need to pay special attention to pipeline creation for the remainder of the quarter? Is there a range for the forecast, like a high or low? Are there a few major deals that will make or break your quarter? Now that we've spoken about all of this data, and there is a lot of it, Dawn will speak about how to manage that data and the insights dynamically.
Okay, thanks, Helen. So I want to start by asking a couple of questions of the audience. So for those of you out there, how often have we come up with forecast numbers that have not met the sniff test? And how many of us have been in market cycles that have changed drastically? I know, I've been in the business a while. This is not my first downturn rodeo. And for the leaders out there, how often have you been in a board meeting where a significant percentage of the opportunities were removed the last week of the quarter? So what we want to do is we want to avoid all of this. And how we do it is with what we call this top-down and bottoms-up approach. So we usually start our forecast with a top-down approach, looking at the market, the historical trends, and the characteristics to create your target addressable market, your total addressable market, your serviceable addressable market, and your serviceable attainable market, your TAM, SAM, and SOM. However, I want you to note that this happens at a point in time. And usually it happens in a different department from sales. I know as a CMO that I have created numerous top-down analyses that have taken me weeks to do, never to be revisited. So what happens is that this needs to be counterbalanced with what's happening in the field. What's happening in the field on the geo level, at the segment level, and at the use case level. So what your managers need to do is they need to take this feet on the ground data and own the counter creation of the SOM and balance that. And you do that in order to balance expectations regarding the forecast. So without taking that feet on the ground data, making sure that again that you're counterbalancing, that you're stress test, that you're pressure testing it, you have the real potential for a big miss with no explanation as to why. And I want to talk about, this doesn't need to be a complex spreadsheet. It can be very simple. It can even be a sanity check on a paper napkin. But it does need to happen, and it needs to happen at each manager level. I personally think that spreadsheets, when you create all these very complex spreadsheets, it's often a way to hide things, right? Let's overwhelm them with data, and maybe they won't ask me the hard questions. But you really just need to say, what's going on? Is what we said when we did the top down, is that realistic? And the benefit of not doing this bottoms up sanity check is what we call buffer. Each man, and it gets bigger and better. It gets bigger and bigger with each manager layer until you get to the point where you're at the CEO level, and all of a sudden there's this 30% buffer built in. But what people don't realize is that these buffers create tremendous pressure at the top of the funnel that cascades through to every role. So if you think about a marketing team that is tasked with more leads and a sales team that is tasked with more deals, that's more resources to support them, more time, and much less time focused on the strategic deals that you need, right? And so that's what we're trying to solve here. And and I think Helen's going to tell us how Discern's going to help us with all of that.
Okay, so we cannot do this webinar without making a quick plug for Discern. So Discern really supports all three previously discussed Ds. So for discipline, Discern provides a forecast module that allows users to collaborate and forecast on a weekly basis and see a summary to understand the accuracy and patterns of your company's forecast. We mentioned the pitfalls of manual spreadsheets. With Discern's analytics and reporting, every number can be drilled down to opportunities with the latest data on these opportunities. For diagnose, remember we talked about weighted pipeline being deceiving? Discern automatically analyzes the conversion rates by stage or by forecast category so that companies get a true weighted pipeline that's based on history and current reality. Discern also provides an AI forecast for each opportunity so that you can identify problem areas in your pipeline quickly. For dynamic, Discern has a dashboard that provides a very high-level view of sales performance for each quarter or each month. For bottoms up, we provide detailed activity data on every opportunity and AE. So Discern is a platform with all data and workflow in one place to support a company's forecasting and sales management journey. Therefore, it is the fourth D. So with all of this content, I think we're ready for Q&A.